term squeeze in trading? Here's a short analogy to help you visualize this phenomenon before we get down to the nitty-gritty. Say John enters a bank and has the option to stand in Q1 or Q2. From his perspective, Q1 is shorter and moving faster than Q2. So, naturally, he concludes that he'll be served earlier if he chose to stand in Q1. However, after a couple of minutes, Q1's teller is closed, and so he has to switch to the other queue, which is now considerably longer. At the end of the day, John spends more time at the bank than he predicted. In the same way in trading, squeezes happen when the price of an asset goes against the trader's predictions, forcing them to close out their positions and eventually prompting a rapid rise or fall in the asset's price. Generally, there are two types of squeezes: short squeezes and long squeezes. A short squeeze happens when many investors short an asset, but its price rises instead. Shorting, in simple terms, is the act of borrowing an asset and selling it immediately, since you believe that its price will fall, then later buying it back at a lower price and pocketing the difference as your profit. Let's now break down how a short squeeze happens by looking at this example. Asset V's price looks like it's about to drop, and many investors decide to short the asset. However, things don't go quite as planned. The price of asset V rises instead. This causes panic, and short sellers may scramble to close out their positions as fast as possible to reduce losses. Remember that for short sellers to close out their positions, they have to buy back asset V. When this happens, the sudden surge in demand to buy the asset further sends its price even higher. And this squeezes even more short sellers out of their positions, therefore causing a rapid rise in price. A long squeeze, on the other hand, is the opposite of a short squeeze, in that many investors take a long position instead, basically betting that the price of the asset will rise. So when the price of the asset falls and panic sets in, traders have to close out their long positions by selling the asset, which causes its price to drop even further. A great example of a squeeze is the GameStop Eat the Rich saga, when Reddit users coordinated to pump up the price of GameStop's shares and trapped short sellers who'd bet on the price of the stock falling. This led to a rapid rise in the price of the stock and, as a result, massive losses for hedge funds.